Broker Bulletin acknowledges the traditional custodians of all the lands across the country on which we record our podcast and pays its respect to all Aboriginal and Torres Strait Islander people. Welcome to the Broker Bulletin podcast, where better begins. Join us as we chat with brokers about what's working for them, what drives them, and the real challenges and wins that matter most right now.
Welcome. I'm Blake Chandler, your broker. I'm first-time host, so excited to be here. And here with Joel from Thinktank. Mate, welcome.
Thanks, Blake. Thanks for having me. I'm Joel Harrison, Head of Partnerships and Distribution from Thinktank. Today, mate, we're going to unpack a little bit around, I suppose, recent budget changes and what opportunities there might be around the corner for a lot of the brokers listening today.
Looking forward to it. I actually think it's a bit of a hot topic. So maybe after this, there'll be lots of viewers. So we'll soon see. But before we dive into the budget, I think about Thinktank, and I'm in the broker game because I believe in relationships with my customers, relationships with banks. So give me a brief rundown on Thinktank. You've been around a while. How do you look after your customers? How do you look after your brokers? What are your goals?
Well, it's good timing because this year's actually Thinktank's 20-year anniversary. We're broker only, started by a couple of original founders that are still around, kind of pioneers of the non-bank space 20 years ago, coming up with that 30-year term on commercial property, set and forget style stuff that really, I suppose, home loan style commercial property transaction that we pioneered 20 years ago. The business has grown. I've been here for nearly 10 years now. When I started, it was about 35 staff. We've now got just over 200 staff nationally, offices in Brisbane, Melbourne, Sydney, staff on the ground in Perth and Adelaide as well. We've got a book size of about 9.5 billion, nearly 10 billion under management. It's grown exponentially in the last couple of years in particular. And all of that thanks to our aggregator and broker partners because we're broker only. So traditional commercial lender, we've done it a bit differently. So 20 years commercial lending and then stepped into the resi space quite heavily about 5 years ago. Whereas most other non-banks, as you know, Blake, have sort of done the opposite where a lot of non-bank resi lenders are now stepping into the commercial space.
Tell me about how you provide solutions to brokers because you just mentioned growth then. And I was like, okay, so obviously, brokers will be using you for a reason. Why do you think brokers come to Thinktank, or why should they?
First and foremost, I actually think it's our people and our ethos around really helping brokers grow their business. At the end of the day, we want to see brokers become successful, whether we help educate them writing more commercial, or whether they're already commercial writers looking to write more residential, whatever that may be. Our team are exceptionally good, but the solutions we offer are common sense. You know, a lot of people say to me, oh, common sense isn't that common, but we do apply.
It's not.
Case in point. But we've always prided ourselves on really giving simple, cost-effective solutions to SME borrowers that are looking for a loan that, you know what, it might just not tick one box for a bank. But as a non-bank, it's not a square peg in a square hole. You're quite often having to shape some of these solutions to really make it work for the borrower. But what we never forget is that we have two customers at Thinktank. We've got the broker as our customer to help introduce, and then we've got that end borrower making sure we've got great solutions for them with commercial, residential, low doc residential. We'll touch on residential SMSF today and commercial SMSF, and we also do private lending as well.
Yeah, amazing. Now, I feel like I'm opening a can of worms by getting into the federal budget.
Yes.
It is a hot topic.
Yeah.
And there's been, I would say, a lot of noise about the budget.
Yep.
Right? And depending on, my LinkedIn stream is just full of brokers and industry people talking about the budget.
Yep.
So there is a lot of noise. We're on the positive, negative, but there's also, we have to work with this. And I really believe brokers' goal is to just use facts to guide their clients through these changes.
Yeah.
Where do you see from a broker's point of view and how is Thinktank thinking about what does a broker do next with these changes? Like where are opportunities?
Yeah, look, I think there's a lot of headlines, as you rightly point out, and it depends on which one do you read. Is it a really positive take on the changes or is it a negative? And there's probably a bit of both, realistically. So, yeah, there's been some tax changes and we won't jump into great detail on that. But on the resi side, there's some implications there for residential SMSF now no longer being available. Obviously, some CGT changes as well around what's happening there with a bit of grandfathering going on. But the opportunity really comes down to that borrowers will take their time to digest what's gone through, and brokers are much the same. But ultimately, the volumes will shift. So brokers and borrowers and their accountants and financial planners are now going to need to be much more strategic around what structure do I buy the property under. And to our delight, being a 20-year commercial lender, we definitely see that sentiment shifting towards more commercial assets being purchased. The fundamentals of commercial don't change. And now it's just getting those borrowers more comfortable with, as you know, mate, from your book point of view, mum and dad investors quite comfortable with residential property. We do see them shifting to commercial, but that might take a little bit of time, as you know, Blake.
Yep. And are you guys, with your self-managed super fund lending, you were in the resi, how did that feel when the news came out, if I can ask? Like, because you'd have teams in there, you would have built the product, like time,
Absolutely.
money, energy from a lender. And you think if it's not just the client and the broker where things change, it's the lenders and the businesses. So how did your team take the news, and how have you pivoted with your staff and your vision for self-managed super fund lending?
Yeah, well, as you can imagine, we all sort of knew what was proposed coming with the CGT changes and those sort of things with the tax changes around that. So everyone had kind of geared up, getting ready that, there'll be some change on that. People might move structures around. And that's where the opportunity for the broker is around, if they are talking strategically around, do I move it from a trust to a company, but there's potential implications as we spoke about earlier. But with the resi SMSF one, it certainly came out of left field. I don't think anyone saw that one coming as quickly and as abruptly as it did. But again, that comes with more opportunity now. So yes, we've seen a huge spike in residential SMSF applications at the moment, people trying to get in, obviously for the cutoff date, I think it's August 10th, where you've got to have your contracts and everything signed. For us, we're still open for business. We've seen, as I said, a huge increase in resi SMSF volume. Lots of clients getting pre-approved, ready to go, want to buy something. But we're still happy to help with resi SMSF refis. Will continue, and we'll still facilitate purchase contracts for so long as they're signed compliantly before the cutoff date as well. Because a lot of people, as you know, like they're buying off the plan. It's not going to settle in the next 30 to 60 days. So we'll still help those borrowers through that situation as well.
Yeah, that's really good to hear. I mean, I remember, I think when the news came out, I'd actually, and this is not a joke, I'd set aside the day to plan a SMSF resi webinar for my clients.
Oh, yes.
and I literally was, planning the webinar, and LinkedIn feed went off, and I'm like, what is this?
Yeah.
So again, like, people have to pivot, and it sounds like you guys have pivoted, and you're still there to look after the customers that are still in the pipeline, still, working towards a cutoff date and helping them purchase their properties.
Absolutely. And we're in a privileged position where we've built a really diversified business. So we don't just write residential SMSF. We write a lot of commercial SMSF, a lot of company trust structures where you've got SMSF unit holders, all these types of different things that now that's where I see the opportunity lies. The traditional resi SMSF loan won't be available anymore for a true purchase, but the ability to look at it differently and get your accountants and financial planners involved, there'll still be opportunity. It's just really guiding those borrowers through that process now around what does that look like from a funding point of view, and then how can we bring the accountants and planners in early to make sure we get those strategies right from the get-go. So
self-managed super funds are still around.
Yes.
Commercial property is the opportunity.
Yeah.
How do you guys see that from a numbers perspective, and how you can handle that growth in commercial properties? Have you planned for or forecasted where you see that going for you guys?
Yeah, absolutely. We see a percentage of some of those borrowers shifting from residential SMSF into commercial SMSF. The traditional borrower for us that we've seen over our tenure writing SMSF for nearly 10 years has been commercial owner occupied. This is going to shift to more of that true investment style where I'm buying a commercial warehouse or a commercial property, and they're looking to buy it more of a pure investment style. I think the fundamentals of commercial property won't change there, but that's where the borrowers are going to really have to understand that. And that's where I think the brokers can help guide them around, particularly the broker like yourself that writes commercial, resi, and everything in under the one banner. You can talk them through, well, this is what it looks like on a resi purchase, but if you buy commercial, these are some of the key things you're looking for. Good tenants, long terms, that kind of stuff. Buying a speculative commercial property in an SMSF in a off the plan scenario with an unknown tenant, still achievable, but obviously quite restrictive around what you can do with those properties in some respects if it's under an SMSF structure. And you got to make sure you get your planning right up front.
Yeah, so a lot more advice on the actual property. That makes a lot of sense.
Yeah.
SMSF, next big one. I mean, they're all big ones, I think.
Yeah,
but
absolutely.
But negative gearing too.
Yes.
So, residential properties, negative gearing.
Yep.
What are the opportunities there, and how you guys handle that change?
Well, you can see a clear strategy from the government around the negative gearing changes there. I think a lot of, and I'm probably getting off topic here a little bit around not just Thinktank, but you read a lot of the headlines that negative gearing's dead. That's not the case at all. Negative gearing still applies to commercial property as it always has. So there's no real change there, which is a good news outcome and why we see some more opportunity there. But even in the resi space, you've got the ability to apply that negative gearing and the CGT concessions to construction loans. So a lot of I suppose the information I'm seeing online is, everyone's going to have to build way out of town and right on the fringes. And apologies, Blake, I'm a Melbourneite, so I can't really reference any Sydney fringe suburbs. In Melbourne, you're talking places like your Mernda and your Meltons and these really fringe suburbs that everyone's thinking that's where you're going to build. I think the opportunity for a lot of borrowers will be where they'll find inner city suburbs where they can buy an old house on a big block and build a couple of townhouses, 2 duplexes, and still get those negative gearing aspects applied to their tax strategy. For us, we did a little bit of analysis, and when I say a little bit, we reran quite a few files where they did have negative gearing, and it was only around 10% that had a pretty interesting impact on their servicing. The vast majority, there was actually no major change in their actual serviceability when they lost that negative gearing impact. Now, that will change lender to lender, don't get me wrong, but I'd say still plenty of opportunity in that space, and I do think you'll see more borrowers pushing towards that, and probably more lenders even coming out with more construction products and sort of starting to shape some more competitive nature in that, because the banks do it really well, but a lot of the non-banks haven't really stepped into that construction space on a large scale. Definitely see that as an opportunity for brokers to help. We want brokers to help shape product, push your non-bank lenders, not just Thinktank. What can you help? You touched on it before. What solutions can you offer? And non-banks, including Thinktank, are exceptionally good at creating things that actually fit the borrower's profile.
I guess if I stay on negative gearing though, what do you think's been misinterpreted? Like what is maybe not gotten out there that people maybe, this budget's only just hit. People are still a bit confused, I'd say. It's not just, let's run with it. As an example, like I've spoken to a couple of BDMs to make sure that their servicing calculators still took into account neutral gearing. What do you think that people don't understand about this negative gearing changes? Like what, if we could paint a bit of a picture for people to get their understanding and get their bearings?
Look, I think the clear one is the amount of headlines that would make the average borrower. We have to remember, we work in the industry. You and I talk about negative gearing and servicing and properties and LVRs and structures all the time. So your more sophisticated borrowers, they certainly understand what these tax implications mean, whether it's negative gearing, CGT changes, discretionary trust being impacted more so than some other types as well. I think the biggest misconception that I'm still seeing around, whether it's at work, around family, at dinner tables, and all the things that are being discussed when you have major tax reform, is they all think negative gearing's gone. The general consumer are going, it's not there anymore. And I see that's where, as brokers and lenders, we can help re-educate and go, no, it's still there. And we touched on it before, that guidance around really driving the relationship with the borrowers. No. If you still want to use negative gearing and you want CGT concessions, then these are the types of assets you can look at buying. So, or building, like we said. So yes, it's changed the game a little bit, but demand is just going to shift, and it's really helping those borrowers understand some of those changes.
Exactly. Another big change was capital gains tax. I mean, that's affecting, I guess, not just investment properties, but businesses. It's quite a big net that they've cast there. Has Thinktank made any changes or have any thoughts on how that's going to affect your business or borrowers or lenders?
Yeah, so for us, it's getting ready for the change. So what I mean by that is we do see borrowers now starting to shift strategy around structures they own properties under. So the brokers that get in front of that and with their accountants and referral partners and financial planners to understand, okay, you and I own it under a discretionary trust now, we might shift it into a company or a different structure, where that does have its implications. We don't need to dive into stamp duty and all the rest of it, but you will see people start to shift structure for tax planning strategies. It's more common with self-employed borrowers than your traditional mum and dads from what we see. But we understand that space really well. We do 85% of our volume in the resi space in that company trust borrower structure. So for us, it's just making sure we've got nice, smooth processes. We understand the why. We get involved early, workshop these transactions with your BDMs, your accountants, and your financial planners really upfront and ensure you get the right outcome. But yeah, look, the CGT change, it's a big one. I think there was a fair bit of noise about when John Howard changed it. I think it was 1999 when he changed it to the 50% discount. Some of the things that I see happening, I think people that have that concession will now hold property, particularly in the more blue chip suburbs. They will want to keep that for as long as they possibly can, which will then probably create a bit of a supply and demand issue in some of those areas where the government were hoping that first homeowners can come in and buy some of these things. But if you've got some of those more advantageous tax advantages, highly likely that the more sophisticated and I suppose wealthier borrowers will try and retain that for as long as possible. The opportunity for some owner-occupiers to move because they bought the property that they live in prior to the tax change dates from when the budget night came out, they might retain those properties and then rent them out to still keep those tax changes as well. So yeah, there's a few different things that will come from it. But I think for small business, that's where I see it impacting a lot of Australia, a lot of people self-employed, a lot of people employed by small businesses in this country. And that's probably one of the more negative things that have changed around the CGT changes to small business. Is it detrimental? No, people will get used to it and they'll work ways to tax plan well. But yeah, definitely that's probably where I see it as a bit of a negative change from a small business point of view.
I wonder, I've been talking to clients for, 15 plus years on debt as the good, the bad and the ugly.
Yep.
Which debt you should focus on paying down quicker, which one, even though it's still debt, has advantages like negative gearing. And I've had a lot more clients want to, come to me and they're much more open to having their investment properties now interest only.
Yep.
Because it's the investment property that is still got that negative gearing status because they've owned it prior to these changes. Have you guys seen any change in your books on your investor book of moving towards interest only a bit more at all, or
not
do you
yet?
Think it's too early to?
Yeah, it's probably a bit early to tell, but most of the stuff we do is company trust loans anyway, where they are looking to free up cash flow. So they will pick to do that interest only term for the first 5 years. But I agree with you. I actually have also started to see, and just again, talking around the grounds, talking to brokers and borrowers alike, even owner occupiers now looking at, well, to that point we spoke about earlier, do I really concentrate on paying the debt down hard, or do I put it into an offset account so that I can keep the balance as high as possible from a tax point of view? So I think we will definitely see more water under the bridge over the next 6 to 12 months around what strategies people play. But cash flow's always been king.
Yep.
Now, whether you're a mum and dad investor buying your first or second investment property, whether you're a small business owner trying to free up cash flow, it's one of the biggest reasons Thinktank in the early days came up with a 30-year term for commercial property. We couldn't compete with a bank on rate on a 15-year term. 30-year term spreads out that monthly commitment, lower monthly payment, creates cash flow. And in the current economic environment with rates going up, inflation still going up as much as the RBA trying to keep that under control, and the cost of living not getting any cheaper, cash flow is definitely going to be king in all facets of funding over the next little while.
Let's talk a bit on commercial property, because that 30-year terms, I remember 15 years ago doing commercial property, and it really was that, it was mainly the majors in that space, and it really was that 3x3, or, they have to review it. And I remember clients are going, well, I'm coming to the bank to review my home loan, but I'm making repayments. The rent's coming in, my income's not changed. Why do I have to have the risk of them not extending the term? And I think the 30-year term makes common sense to me, like we talked about before. What made you guys step in that direction? What's been the feedback?
I suppose going back to the DNA of Thinktank when it very first started, most of our original founders came from a corporate institutional background where they had seen all the pain points that you're talking about, where clients met all the repayments, done nothing wrong, Val comes in short for some reason, or the lease isn't renewed, and then all of a sudden the bank's sitting there saying, hang on, you need to debt reduce, or you need to sell an asset, or you're outside your covenants, you're not servicing as per our metrics, even though you've made all of your payments. So that was where that philosophy came from. Well, let's create a product that's set and forget in nature, no annual reviews, no revaluations. Small business operators want to concentrate on running their business, not having to jump through hoops every 12 months, 2 years to actually keep a loan facility going that they've never missed a payment on. And that's how we sort of built our first foray of Thinktank for the first 5 or 10 years. And so that solution continues to grow. We've got many banks that have now followed suit. I always find it interesting that the non-banks sort of started this space, and now you've got plenty of the majors offering 30-year terms up to that sort of $2 or $3 million space. But we do it all the way up to $10 million. So the ability to borrow $10 million with no reviews, revals, no covenant testing, the more sophisticated borrowers are actually sitting there going, hang on, yeah, your rate's a bit dearer than the bank, but I've got a committed 30-year term and I don't have to worry about it anymore. Cool. I can either let that asset pay it off, like you said, either neutrally geared or positively geared, which is going to be a really critical phase of when people look at commercial property now. Yes, you can negatively gear, but you're probably going to want a cash flow positive property. But yeah, more and more borrowers starting to head towards that non-bank space where it's a more common sense, set and forget, I don't really need to think about it type situation. Plenty of brokers throughout the LMG network telling me, you know what? The non-banks are actually becoming one of my primary go-tos before I go to a major for certain asset classes. You'll always need a bank for certain things, and they do an exceptionally good job in some spaces. But I think we've really got that set and forget facility underway quite well, and we're well known for it, which is good.
That's great. Joel, glad to be here with you because I just settled a Thinktank deal last month, I have to say,
Thank you.
Yeah, that's right. Sucking up a bit. But, it was a great experience. It was about looking after self-employed clients, common sense like you've talked about, and it was rate as well compared to other low-doc lenders. Where do you guys see yourself competing in that space rate-wise, and do you see any RBA decreases coming in the near future?
Nothing like a double-edged sword question. No, look, our philosophy's always tried to be, we're never usually the cheapest, but we're always competitive on price. So whether it's residential, resi SMSF, commercial, our rates are usually within 10 or 15 points of most of your non-bank competitors that are similar to us. So when anyone thinks of Thinktank, they're thinking of the likes of a Latrobe and a Liberty, your Pepper and your RedZs. The good news as a broker now is lots of non-bank players have stepped into this space and we all do different things really, really well. So pricing wise, I'd always say we're pretty competitive across all of it. With regards to rate movements, look, it depends on what data you look at the moment, doesn't it? Underlying inflation is still going up. And then with what has just unfolded in the last week or so over in the Middle East with Iran and America going back at it again, I think a lot of the governments around the world were hoping that that had calmed itself, bringing the cost of fuel and oil and everything that comes off the back of that down. Does that really come through now? And do we still see inflation continue to spike? Potentially. Rate movement wise, again, you look at all the different major banks and second tier banks, it's like a flip of a coin as to whether they think rates are going up or down. Look, personally, I probably see maybe one more hike coming this year and then it's staying quite flat for a while the RBA sit to see where do things land? What happens with inflation? You've already got borrowers quite stretched at the moment with 13 or 14 rate rises in quick succession a couple of years ago. We've just had another 3. So yeah, probably one more if I was to hazard a guess with maybe 12 of 18 months of a bit of a watch and see. And then hopefully not too long.
And we have to watch and see with these tax changes too. Like that's
Absolutely.
going to make an impact on the property market and how much the RBA likes the hold on that.
Yeah, look, there's already sort of, I suppose, what would you call it, early data showing that the property prices are starting to fall across the country. We've seen, I'm Melbourne, don't hold that against me. We've had a pretty rough trot down there property-wise for a while. Sydney's coming off, Brisbane and some of the other capital cities that were bucking that trend, now seeing the clearance rates quite low and coming off as well. But I think everyone has to remember, we've been through lots of property correction cycles. So yes, things will come back. If you bought at the peak, that's a tough one. But if you bought 4 or 5 years ago and you've made 30 or 40% growth in that period and it comes back 10, you're still in front and things will come back. We still have a massive supply and demand issue where we've got high immigration, lack of houses being built, not enough housing out there. Prices will stabilize at some point, and the tax change is not ideal, but they won't ruin things. Things will just shift and people will look at other ways to invest.
And I guess, moving away from the tax changes, but, using Thinktank as I did, I mentioned at the beginning, like I really believe we're in a relationship game.
Absolutely.
And even with these changes, like having this conversation. So I think the way people can get through these changes is talk to other brokers, learn from them, reach out to your lenders, talk to them like we are today.
Yeah.
I had a really good experience. Like obviously shout out to Rob and the team. You can go back and say thank you for his support, but having that person, that BDM to work with you on deals, be there, be responsive is super important to a broker. How do you guys select your team and what's the ethos of the team, the relationship managers on, what are they expected to do to make sure the brokers have that good experience?
Look, the first thing that always comes to the forefront when we're looking to recruit anyone, I'll go back a step before I talk about recruitment. We've got some of the longest tenured staff in the industry. So on the commercial side, in my team, I've got one staff member that's been with us for 20 years, another one that's 12 years, one that's 10 years, multiples that are between 5 and 8 years. So we have really good tenure with the team, and that gives brokers confidence that you can pick up the phone and ring Rob and you're going to get the same person. They understand the product. They really do partner with you. They work closely with you. We're always a relationship-driven business. For us to be successful, we want our brokers to be successful because if you're writing good business, we're writing good business. It's a very much a joint venture. But when it comes to recruitment, we have brought on some new faces in the last little while because we've had a bit of growth, which has been great. We've got Gillian, who we've just brought on in our WA portfolio. So shout out to Gillian. She started this week. And Sam Flood's another one that's just started in New South Wales as well. But what we look for first is just being a good human with great culture. So you can teach people the skills of analyzing a loan and looking at financials and running through the numbers, but for us, the big reason, it's why I think we have such good tenure, good culture breeds good outcomes.
Yep, perfect. Back to the changes.
The hard-hitting questions. Let's do it.
Just something like we're talking about, like where's the opportunities for brokers, and we talk about new builds, we talk about commercial and self-managed super fund. We talk about existing properties that still hold that negative gearing status, etc. Have you guys gone, where's the opportunity for you for Thinktank? Like, is there any products? Could you give a rate discount on if it is a new build to take advantage. Hey, there's going to be more growth in this area. Let's make sure we can get it to us. Is there anything coming up with Thinktank, or how do you guys think about that?
There's definitely, for us, we've got a really broad range of products already. And so what we want to emphasize over the next 12, 18 months is doing those exceptionally well. But what I'd openly say is, we're always looking for new opportunities. So for us, without brokers, we don't have a business. So if there is holes that you need us to plug as a broker, and there's a particular sort of area in finance that you feel is being underserved or you want us to fill, we have done that for years and years. So many of the products, like I said, I've been here 10 years. We do a GST facility where if you're buying a vacant commercial property, we'll fund the GST over and above your normal LVRs, inside and outside self-managed super fund loans. That idea actually came from a workshop with myself, my old GM, and a few brokers in a room where they said, we've got this issue where client goes to buy a property and then it's vacant. And so we've got a GST bill that they just don't really want to have to pay. And so we created the product off the back of that to be able to fund that solution. So will we look at things like construction loans? Probably. We've just shifted our pricing. So we've dropped our rates on resi SMSF to make sure the borrowers are getting the best outcomes they can possibly get while it's still open. We've just shifted our rates down on full doc commercial as well as SMSF commercial. And we're also running a promotion at the moment where we're actually discounting the establishment fees on commercial SMSF by 50% as well. So we're always looking to be as dynamic as possible. There's a lot of competition in the non-bank space, which as a broker is great for us. It keeps us on our toes, which is awesome. But forever looking for new opportunities. And for anyone listening, if there is something you need us to fill or a real gap that you see that no lender's really doing for you, pick up the phone, give me a call, send me an email. Always happy to have a chat. For us, building good broker solutions gives you great outcomes that help you grow your business.
Perfect. Teamwork.
Absolutely.
Speaking of whoever's listening, you've got an audience here. Hopefully people are listening to us from and tuning into the Broker Bulletin. Topics aside, if you were to share anything to the broker world, what would be some of your last thoughts? Any topic that you would share with the brokers?
Look, I think there's been a bit of a hoodoo around commercial being really complicated and a bit hard for a long, long time. And don't get me wrong, coming from a commercial background, there's aspects of it that are quite technical and complicated. But in the next 12 months or 18 months, more and more borrowers are going to be like your business coming to you asking for what structure do I need? Now, obviously, as a broker, you're not going to give tax advice, but that's where you bring in your accountants and your planners to make sure you get that game plan together early. But the data doesn't lie. The MFAA have been doing the numbers. Commercial finance through brokers is growing exponentially. You've got 80% of home loans ballpark being written by a broker, and at the moment around 30%, 35% of commercial volume going through broker. I personally think that's going to be closer to 50 to 60% in the next 2 to 5 years. So the broker that gets in front of that really gets their head around what we do for commercial lending is quite simple. And that's what most mum and dad investors are going to want. That's the opportunity. Get involved, make sure you've got great referral partners. To your point, workshop with your BDMs, create a great network around you, lean on the lenders, lean on your aggregators. Like LMG have got some of the best educational content in the industry. So make sure you're reaching out to your partnership manager and the team to go, hey, I want to talk to Claire George and understand more about commercial. What courses can I get involved with? Yep. So don't I know we can look at this and go, look, the changes will impact the residential space, but now the opportunity is how can I pivot and get really confident in writing commercial? The quicker you get that confidence, the more the opportunity that sits on your desk already is already there. I think that's probably the biggest thing that I notice. So many self-employed borrowers going through a broker's portfolio, lots of commercial opportunity, not necessarily always being looked after.
You just said something really important that I think is important for every single broker. These are the biggest tax changes we've probably seen in most of our lifetimes.
Yeah, agree.
To be honest.
Generational tax change.
If a broker doesn't have an accountant as a referral partner, I think it now more than ever they need a really good accountant as a referral partner. And I'm not talking about us getting referrals from the accountant. Yeah. That's always great. I mean someone you can refer your clients to. Absolutely. Because the clients need that advice and you need that advice from their accountants to structure the deals. So I think now more than ever, if you as a broker don't have a good accountant, that should be your first business goal.
Absolutely. Because if we get these structures wrong, now they're very hard to unwind, particularly if it's SMSF. So, heavily regulated, which I love because it gives you a really clear set of guidelines to work in. And that's where I think another opportunity is with all the changes around tax with what's going on, it is going to make that company trust stuff a little bit more convoluted until the water goes under the bridge, the government work out exactly where it's going to land. Accountants will still be working through all of this at the moment, but SMSF remains vastly unchanged. No CGT changes. You don't really generally look to negative gear under an SMSF structure anyway because of the low tax environment. So that's the space where I think more borrowers will look towards, and where the opportunity as a broker, it's a great stepping stone. If you've written resi SMSF, you can definitely do commercial SMSF with Thinktank.
So negative gearing outside super, there should be more commercial business for brokers and for you guys. And in the self-managed super fund, there should be more commercial business as well. It's the only resort. So commercial is really a key point for brokers to focus on.
We love commercial, as you can tell.
Good. Well, good. You need to in this day and age.
Absolutely.
I've helped a lot of people purchase commercial property, but I've never invested in commercial myself. I've always been a resi guy where I've put my money. I get the benefits. I'd love to probably do a commercial property in my self-managed super fund myself. But at the same time, I know, there's certain retail areas where I see up for lease, commercial took a really big hit also in COVID. I guess I started noticing again, hey, there's some empty shops around. The amount of boxes my wife gets delivered to my front door means I'm thinking online business is not retail, but I'm not bringing down retail. I think there's some great opportunities in commercial, but I don't understand them. I guess if someone was to invest in commercial, where is the place to invest, and what would you be looking for?
Well, yeah, it's a really good question, isn't it? And I think that's going to be one of the key things that borrowers would need to try and understand a bit better. Because I think mum and dads are generally quite comfortable with resi property, like you just touched on, right? We know generally every 10 years it doubles in value. We're looking for a rent return of 2 to 3%. Negative gearing, like we sort of touched on as well, is there and isn't there depending on when you bought and how you bought. But with commercial, I suppose the fundamentals haven't changed. You're still looking for good quality assets. And what we did see post-COVID, like you said, is there was a bit of a glut of office space in certain areas. But a lot of those landlords have been much more adaptable now. So rather than leasing an entire floor to one big business, they've cut that up into, say, 3 or 4 different tenancies. And we touched on this early. That's great. But as a borrower, if you're taking that loan to a mainstream lender that's going to look at your weighted average lease expiry and you've got 4 different leases and then you've got to start jumping through all these hoops, that's where the non-banks can help. So look, from a property trend point of view, industrial is still doing quite well. There's no real concerns there from our perspective. It has slowed a little bit. It was growing exponentially post-COVID. To your point, instead of small businesses housing all their stuff in little areas, it was industrial properties, the Amazons of the world building huge industrial property. We have certainly seen a lean towards some specialised assets, so seeing a lot more funding requests for things like childcare centres. Good yield. Quite a specialised asset in some respects. And to your point earlier, around adapting, we moved our policy on childcare centres where we'll now do 80% LVR on a childcare centre, which is quite unique on a 30-year term. More people looking at boarding houses and rooming houses. And again, it's a resi asset. And I think mum and dads are comfortable with that because it's residential, but the yield is quite good. Unique, of course. But when you're looking for commercial property, you touched on it before, you want a good property in a good location that is going to rent. On face value, I can do 80% on an office space, but am I going to do 80% on an office space in a fringe suburb on the outskirts of Sydney? Or am I going to do 80% on a fringe suburb in Sydney? Well, it comes down to, we touched on this before, what's the lease look like? Who's the tenant? How long have they been there? What's the letting up period? All these kinds of things. So yeah, with commercial property, we certainly see industrial continuing to do well. Good properties in good locations always attracting capital and good buyers, and there'll be a bit of competition for that. And this will be interesting to see how much risk a borrower is willing to take on the more speculative purchase, like buying something off the plan or in a different area. But commercial continues to go strong, but it's a different play. Normally with commercial, you're talking rental yield versus just pure capital growth like residential. So yeah, really keen to see how that plays out with more people now probably moving into the commercial space. Does that start to push the price points up and muck around with some of the yields that you get on certain assets as well? What are they willing to pay for it to secure it based on the rent return?
Well, Joel, that's been awesome. We ask one last question.
Yes.
On Broker Bulletin. And this is from a corporate point of view, broker point of view, but any business, what's the 1% change that you've made in your career at some point in time that's given you the most impact? There's little tweaks you can make in your business or in your day-to-day strategies or in your business planning that's made the most difference for you in your career.
I think the biggest thing for me, and it's something I've learned working for Thinktank, I came from bank world where they're big businesses, you're a small cog in a much bigger wheel, which is nothing wrong with that. But for me, it's just being really comfortable with being adaptable to change. And we're in an industry where if you're not adaptable to change, it's very quick and easy to become irrelevant. So for me, the amount of change we've gone through at Thinktank has been exceptional in 10 years, and being really flexible and working with that change, creating new products, creating new teams, working on new ventures, working with more brokers, partnering with our aggregators on a white label, all the different things we've done. I came from a bit of I wouldn't say a fixed mindset in the bank, but I was very much institutionalized. Mm-hmm. And when you walk outside of those four walls and then come into the non-bank space and third-party broker channel, you learn to be adaptable pretty quickly. As a broker, I think the same methodology applies. If you've stuck in one lane for a while, that 1% to change your business from good to great is adapt to change, get in front of it, and make sure you're one of the first leaders to take these changes on by the throat, but I should say by the scruff of the neck, and you will leave some of the competition behind quite quickly. So, and that's hard if you're a long-term just doing one thing. Adaptability sounds easy for me to say on the microphone to everyone listening, but that's been the key thing for me. That's really been the game changer for my career. But it's thanks to working for an institution that's been constantly trying to adapt to change in a forever competitive environment.
Joel, thank you so much for joining us today. I completely enjoyed the conversation. We could do this for longer if you wanted. Some big takeaways. The biggest one for me was, about commercial property as well, where negative gearing still does sit, and the opportunities for brokers in their business to pivot. So thank you very much for your time. Appreciate it.
Blake, thanks for having me. I had an absolute blast. I agree. I think there's lots of opportunities out there for everyone to be had. We're here to help. As a lender that likes to pivot and apply common sense, we'll always have a good solution for the borrowers and the brokers that are out there. So please reach out to my team, reach out to anyone at Thinktank, reach out to any of your LMG white label BDMs as well. And we're always happy to help with any of the funding solutions that your borrowers may need. But thanks for having me, mate. It's been a blast.
Awesome. Thanks, Joel. Appreciate it.
No worries.
Thanks for tuning in to Broker Bulletin. We would hate for you to miss an episode. Subscribe to Broker Bulletin in your favourite podcast app. Has this episode been helpful? We'd love you to rate and review us. It'll help us deliver content that's useful to you and help others discover us. If you have great ideas for topics worth tackling or have burning questions you'd like addressed on an upcoming episode, reach out. Links in the show notes. See you next time.